Welcome to Chapter 12 on Project Appraisal. This is a key area in your management accounting studies, so it's not just important to your F2 exam, you will also see this chapter will continue throughout the management accounting theme in your ACCA qualification. So it's an important area for you to get your head around. What we're looking at in Project Appraisal is we're trying to decide whether a company should invest in a new opportunity for a long-term project. So therefore, we're looking at items that would appear in the capital expenditure budget. What we need to be comfortable with from this chapter is the different types of technique that can be used to make an investment decision, so to decide whether to invest in a new project or not. This is quite a technical chapter, however there's lots of examples for you to work through to help you with each of the techniques that we're going to look at. One of the first things that we'll introduce in this chapter is the concept of compounding and discounting. So being able to deal with the time value of money. That's something that you need to be comfortable with to be able to apply some of the techniques that will be used for project appraisal. There are a number of different techniques that you will come across in this chapter and in your studies. We will look at a technique called net present value, the internal rate of return, and payback. What you also need to be able to do is to interpret the results. So in other words, be able to make a decision. So to understand whether those techniques will tell you whether to accept a long-term project or to reject a long-term project. Again, if you think about your exam context, this area could come up in either Section A or in Section B of the exam. In the pilot paper, there was a question in Section B of the exam on project appraisal, therefore highlighting that it is an important area of the syllabus. Let's look at your overview diagram in a little bit more detail.
So the three main methods then of project appraisal are payback, which can be either simple or discounted, more about that in a second, net present value, and internal rate of return. Before we get to those project appraisal techniques though, we need to understand some of the nuts and bolts, the mathematics behind those. So we're going to start off by looking at compounding and discounting. So we start off by thinking about compounding. We're looking at making an investment now and seeing how much it's going to be worth in the future. So we've got then the time now, which is known as T0, and then we've got the time in the future, so perhaps 2 or 3 years' time, how much the investment will be worth. And what we're looking at with compounding is thinking about how much the investment is going to be worth in the future. So we're looking at how much we're going to invest now multiplied by 1 plus the rate of interest to the power n. So we're looking then at what we call a compound rate of growth. That is the fact that you earn interest on your interest. In worked example 1, we're going to see an example then of this formula that you need to learn, that the investment in the future is equal to the invested amount now, which in this particular case is $100, multiplied by the rate of interest plus 1 to the power n. So we've got $100 being invested in an account which pays 10% interest. So R is equal to 0.1, and we're looking at 4 years. So n is equal to 4. So in the first year then, we're going to get 10% interest on our initial amount, our $100. So we're going to get $10 of interest. We won't, however, get $10 interest next year because we're also going to earn interest on the interest. So we've got $110 invested, which means that the amount of interest will be $11. So you can work out the amount of interest each year, and if you do that, you'll end up with an investment that is worth $146. The shortcut though is to use the formula. So the investment is equal to $100 multiplied by 1 plus the rate of interest, which is 0.1 to the power 4, because it's being invested for 4 years. So at the end of the 4 years, we'll have $146.41 in the account. So you see that the answer is the same. It's just that this is a much more succinct and quick way to get to the answer rather than working out the amount of interest each particular year. The notation that we have here then at the bottom of the screen is just showing you how you get to that formula for the compounding. I shouldn't worry too much about deriving the formula, you just need to make sure that you can remember it. So how could this be tested? Well, B is investing $500 into a building society account and the rate of interest is 10%. So how much will it be worth in 5 years' time? We've got $500 multiplied by 1 plus the interest rate as a decimal, so that gives us 1.1 to the power 5 because we've got n equal to 5 as we're investing it for 5 years. So it's going to be worth $805.26. In the last example then, n was equal to 5 years. Sometimes though we might see that interest is compounded at a different frequency to annual. So we need to make sure that n in our equation relates to the number of periods for which r is being compounded. So for example, if interest was being received monthly, the amount of interest in a year, we'd be putting it to the power of 12. This is shown in lecture example 2, where we've got $1,000 and it's being invested to earn interest of 6% per 6-month period. And we want to know how much the investment is going to be worth after 1 year. There are 2 parts to this requirement because we want to know how much the investment is, but we also want to know the amount of interest. So again, it's still really important to read the question carefully to make sure that you are giving the right answer. So interest is coming every 6 months. So that means in 1 year, we're going to get 2 lots of interest received. So we're going to be looking then at $1,000 being invested at 6% interest, and n is equal to 2 because we've got 2 periods of interest. So at the end of the year, we're going to have $1,123.60 in the account. We already had 1,000, so the interest earned is $123.60. In the last example then, we were told that it was a 6-month interest rate of 6%. Sometimes then we might see a situation where the annual rate of interest is given, but the interest is being compounded at intervals shorter than a year. This sort of thing is very common, or used to be much more common, with credit card companies. So they would quote an interest rate of 12% per annum. However, they would be adding interest to the unpaid account every single month. And so what we need to do is, if we're given a non-annual compounding rate, we need to calculate an annual equivalent rate or an effective annual interest rate. And the way that we do that is by using this formula, which you need to learn. So 1 plus the effective annual rate is equal to 1 plus r, where r is the period rate, to the power n, so the number of periods in a year. And you might be more familiar with the terminology of APR, because that is now annual percentage rate, and that's something that the banks and building societies have to quote so that you can compare the cost of loans and when interest is paid differently. So we end up with 1 plus the little rate, little r, to the power n for the number of periods that it's being compounded, and then you take off 1 and that will give you the effective annual rate. Here then we've got $300 being invested initially, and we've got a 2% monthly interest rate. And we first of all need to work out how much that investment is going to be worth after 2 years. We've got a monthly rate of interest, so in 2 years we've got 24 months or 24 lots of interests. So S24, or the amount in 2 years, is equal to $300 multiplied by 1.02 to the power 24. When we start to get to things like to the power 24, you can see why using the shortcut formula is very, very useful. So in 2 years' time, we're going to have $482.53 in the account. So that's the answer to part A. The answer to part B then is, well, we need to work out the effective annual rate of interest, or the APR. So the effective annual rate of interest is big R. So 1 plus big R is equal to 1 plus little r to the power n. Well, 1 plus 0.02 to the power n, and that's the number of periods that are going to occur in 1 year. So there are 12 months in 1 year, so that's going to be to the power r. To the power 12. So 1 plus r is equal to 1.2682. But to get r on its own, we need to take 1 off it. That's 0.2682, or 26.82%. So you can see then that the monthly interest rate of 2% might not sound too high, but actually that's going to equate to interest of almost 27% per year, which is a very high APR. Following on from this then is the idea of the nominal rate. So if a bank or a building society or some kind of lender quotes the annual rate as a nominal rate, then we need to actually translate it into an APR. So going back to my credit card idea, the 1% monthly interest rate could be quoted as a 12% annual rate, but actually it's going to be that the APR will be higher than 12% because you'll be charged interest on the interest each month. In lecture example 4, we've got $1,000 invested now at a nominal interest rate of 15%. What we need to do with that nominal rate then is translate it to an APR, or an effective annual rate. And that interest is compounded monthly. So the nominal rate is 15%. If we divide that by 12, that gives us 1.25% as the monthly rate. And what we can do is use that monthly rate of 1.25% to work out how much our investment will grow to during the year. So 1 plus 1.25% as a decimal, to the power 12. So 1.0125 to the power 12 multiplied by 1,000. At the end of the first year, we're going to have $1,160.75. So as a little reminder then of what we've done with compounding, if we had $100, we could invest it for 3 years at 10%, and we could work out how much we would have in 3 years' time by applying the compounding formula. So we'd multiply by 1.1 to the power 3, and we could see that at the end of 3 years our investment would be worth $133.10, and we called that compounding. What we're going to look at now then is basically the reverse of compounding, so it's called discounting. So with discounting, what we're doing is we are taking that future value and saying, what is that worth in today's terms? So we're taking our terminal value and we're putting it back into today's terms, into our present value. And the way that we're going to do that is we could divide by 1.1 to the power 3. So 133.1 divided by 1.1 cubed is equal to $100. Or alternatively, we can say that we multiply by 1 over 1.1 cubed. And we call this the discount factor. And what we're going to do now in the chapter is we're going to have a look at discounting cash flows back to their present value. So we're going to take those future values and we're going to pull them back into today's terms so that we can compare and see which one has the highest present value, even if they have different durations. So as we just said, discounting then is the opposite of compounding. We're going back the other way in that diagram. It's an important technique because it recognises that there's something called the time value of money. If a company invests in a project that could last 3 years, that money is going to be tied up, and if it weren't being used on the project, it would be able to be invested and the company could earn a return on it. So rather than working out all of the terminal values for investment appraisal points, it's better to work out the present value, so how much something is worth in today's terms. And to work out then the present value, that's going to be equal to the future value divided by that 1 plus r to the n. So what it's worth today is a reversal of that first formula that you would have learnt. So in lecture example 5 then, we need to have $1,610 in 5 years' time at T5. And we're going to earn interest of 10% per year, so we need to work out how much we need to invest now so that that amount growing at 10% each year will finally equate to 1,610. So we know then from before that we would take an amount and multiply it by 1.1 to the power 5, and that would equal 1610. So rearranging that formula where x is the amount that we need to invest, we're going to divide the final amount, the terminal value at T5, by 1.1 to the power 5. And the answer that you get on your calculator is 999.68, or basically $1,000. So assuming that you can guarantee that the interest rate is going to stay at 10%, if you pop £1,000 in an account now, in 5 years' time, it will have grown to $1,000, $1,610. How is this useful to us? Well, basically, means that we're indifferent in monetary terms between getting £1,000 now or 1,160 in 5 years' time. Because basically, adjusting for interest, inflation and risk, that £1,000 might buy us 10 items now, and it will buy the same 10 items in 5 years' time. So we will have what we call the same purchasing power with that. So in order to get then from the value in 5 years to the present value, we use a discount factor. So the present value is equal to the terminal value, the amount in the future, multiplied by this discount factor, which is 1 over 1 plus r to the n. And there are two ways then of using this discount factor. There are two ways we can get the discount factor in the exam. We can either use that formula that we've got up there for the discount factor, or we can use the tables. And we're going to have a look at using the tables with the discount factors in a moment. The tables in the exam will give us all of the percentages from 1 to 20 for years 1 to 15. And because they have already been calculated in the exam, it makes more sense to use the tables. If it falls outside of those ranges, then obviously you'll need to use the formula to calculate it, which is why we show you both. So let's have a look then at the tables. At the back of your notes then in Appendix B, you've got the formulae that you're given in the exam, and you've also got these present value tables. The ones that I'm looking at then are on the first page, and it's a good idea to pull these out and have them open whilst you're doing these questions. So let's imagine then from example 5, we were investing for 5 years at 10%. So the discount factor that we would have been looking for is 10%, and we would have wanted the 5-year discount factor. So that is 0.621. And in example 5, the present value was equal to the terminal value of 1,610 multiplied by the discount factor of 0.621. And that gave us the answer of 999.81. So the discount factors then on this table have basically already been calculated for you. So that saves you needing to do that calculation 1 over 1 plus r to the n. So 1 over 1.1 to the power 5 is equal to 0.609. So 0.621. So it's time saving in the exam that all of those have been calculated for you, those discount rates. And it's because we can take them separately from the tables that we say we're multiplying by 1 over 1.r to the n rather than dividing by it when we looked at that initial diagram. So let's keep these tables open and have a look at the rest of the examples. In worked example 2, we need $5,000 at the end of 3 years, and the rate that we're earning interest at is 8%. So how much have we got to pop away now to ensure that in 3 years' time we've got the required $5,000? Well, there are two options then for finding the answer. The first one is to use the tables, and this really is the best one to do in the exam. So we need to look up the discount factor at 8% for years 1 to 3, and that is 0.794. So this time 8% for 3 years, and you can see that's where the 0.794 has come from. I can't stress how important it is that you make sure that you're familiar with these tables ready for the exam. So 5,000 times by 0.794 gives us 3,970. Second method then is to use the formula. So we need to work out the discount factor ourselves, which is 1 divided by 1 plus r to the n. So 1 divided by 1.08 to the power 3. And then we multiply the answer by 5,000. So the answer is the same regardless of the method used. It's just that option 1 is quicker because there's one less calculation to do. Rather than a one-off payment, sometimes we might see an annuity. An annuity is when you get the same amount every single year for a given number of years. In worked example 3, then, we have an annuity. So we're investing $100 now and at the end of the next 3 years. So we've got 4 investments being made of $100 and there's 10% compound interest going on here. And we need to work out how much this investment is going to be worth at the end of the 3rd year, so after the last payment has been made. So it's going to be worth at least $400, but it's also going to be the value of the interest. And that's what we need to calculate. And we're going to use the timeline method here because we're going to prepare a timeline to show visually what happens. So the first $100 then is going to be invested and there will be 3 lots of interest earned on that. So that $100 is going to have grown by 1.1 to the power 3. The second $100, which is invested a year later, will have 2 lots of growth, which is why it's to the power 2. And the third investment made at the end of the 2nd year will only have 1 lot of interest associated with it. And this final amount of $100 will be put into the account on, let's say, the 31st of December. So at the end of the year, it will still only be worth $100. So there's no growth in that one. And if we add all of that up, we get to $464.10. And in a moment, we'll come back to an alternative way of calculating that. But let's go on and have a look at one of the uses of this. So one of the uses of this technique then is to work out the loan payments. So if you take out a loan, then you've got to pay back the principal, the money value borrowed, and you've also got to pay the interest. So what you have to do then is to work out the terminal value of the loan, so the amount that you'll owe at the end, including interest. And then you can work out the instalments, which are the annuity or the repayments. And this terminal value, as I've said, is the amount that you owe in terms of the money you borrowed plus the interest. And we're going to look now at a way of calculating the present value of the annuity. So in the same way with one-off amounts, we wanted to know what it was worth in today's terms. What we're going to be looking at with an annuity is what's the present value of it, so we can make comparisons. What we're going to be seeing now then is the reverse of lecture example 3, where we're going to be working out how much the present value of the investment is. So in worked example 3, we saw that the terminal value of that $100 being invested was $464.10. But what we're going to think about now then is how much it is actually worth in today's terms. So we're going to be using the same kind of timeline approach, but we want to work out how much it's actually going to be worth today. So we've got $100 that was invested at the end of the third year. We've got $100 which was invested at the end of the second year. We've got $100 which was invested at the end of the first year. And we've got $100 that was invested immediately. Now, if we're looking at the present value of the $100 invested immediately is $100. The present value of the $100 invested 1 year later, we need to multiply that by the 1 year cumulative discount factor, the 1 year discount factor from the tables at 10%. The $100 that was invested at the end of the second year needs to be multiplied by the 2 year discount factor, and the $100 that was invested at the end of the third year needs to be multiplied by the 3 year discount factor. So we've got 75.10, 82.60 and 90.90 plus that $100 invested on the first day. So that's got a present value of $348.60. Now you might be right if you're thinking that that seems a rather long-winded way to do it, because what we could use is what's called the cumulative discount factor. So the cumulative discount factor enables us to work out the present value of the annuity. So in this case, that was the $348.60 in a much simpler way. And what we do to work out the present value of an annuity is we add up all of these discount rates. So 0.751 plus 0.826 plus 0.909 is equal to 2.486, and that's known as the cumulative discount factor for years 1 to 3 at 10%. If we look then on the annuity tables so that we don't have to calculate them, this is the second of the two tables in Appendix B. If we look at 10% for 3 years, you can see that we've got a cumulative discount factor of 2.487. So this table then is even more useful than the discount factor table because it's saving you quite a lot of calculations. And again, we have it for years 1 to 15 for 1 to 20%. You don't need to worry about being able to calculate the cumulative discount factors because you won't have them outside of this range in your course. So how are we going to apply the cumulative discount factor to lecture example 6? Well, we've got the cumulative discount factor, which is going to cover off the investments made at years 1, 2 and 3, but we need to add 1 to it because there's also an amount that is being paid immediately and has a present value of 100. So our cumulative discount factor here will be 3.486, and to get our present value, it's equal to the annuity times by the cumulative discount factor. So the annuity is 100 times by 3.486 gives us 348.60. So as you can see, it's a much quicker way to use the cumulative discount factor to work out the present value of an annuity. So the present value is equal to that annuity times by the cumulative discount factor. And those cumulative discount factors on the tables are for years 1 to 3, and you can adjust them. So here we had the first investment at T0, so we added 1 to it. Rather than it being the same amount for a set period of time, we can also have a perpetuity, which has no end. So that amount, that $100, is paid every year into infinity. The present value of a perpetuity is equal to the amount times by 1 over R, or the annuity divided by R. For the formulas to work, as we've said, with either a perpetuity or an annuity, the first payment must be in 1 year's time. Let's imagine then that you've been very lucky and won a competition in the newspaper, and the prize has 2 options. You can either have $1 million now, or you can have $90,000 per year into perpetuity, so forever and ever. When you die, your children get it, and after them, their children. And you have to choose which option you want. So, if you choose option 1, we're all going to be assuming that we aren't going to go and spend it on shoes and handbags and yachts. We assume then that we're going to invest it. So actually, if we can invest this at 10%, perhaps one other thing I should have told you is that the interest rate that you use is 10%. So which option seemed the most appealing? Did you want the $1 million now or the 90,000? Lots of people then will choose the 90,000 because it goes on forever and ever and ever. However, if we took the $1 million now and invested it, so we didn't spend it on fast cars and holidays, we would be able to invest it and earn 10% interest per year, or 100,000 per year. So let's assume then that we took the 100,000 a year and spent that on enjoying ourselves. We could maintain our $1 million and continue to give ourselves an income, and we call that a perpetuity. So the present value of a perpetuity then is basically what you'd be indifferent between the 2 amounts. So the present value of the perpetuity that you could create if the interest rate was 10% is 100,000, and the maximum you'd be prepared to pay at an interest rate of 10% to get 100,000 every year is the $1 million. In example 7 then, we've got a perpetuity of $1,000, and we want to know how much then you'd be prepared to pay for it if the interest rate was 10% and the first payment was going to be in 1 year's time. So the present value is equal to the value of that annuity times by 1 over R. So 1,000 times by 1 over 0.1, or 1,000 divided by 0.1. It's equal to $10,000, because you'd be prepared to pay $10,000 now to get yourself a perpetuity, which was going to pay you that regular income of $1,000 per year. So initially I said that this chapter was going to help us decide whether or not to undertake a project. But so far we've spent quite a lot of time doing calculations around investments. We're going to use that knowledge then to help us undertake these investment appraisal techniques. So we're going to have a look at 3 different techniques: payback, net present value, and internal rate of return. And the time value of money is important when we're making long-term decisions. And this is the idea then that money today is worth more than the same amount of money in the future because of the fact you could invest it and earn interest. There's also an element of inflation, so purchasing power and risk. And all of these things combined together are known as the cost of capital. And that's the compensation that you would require to wait for your money in the future. And we're going to be using the discount factor in place of the cost of capital. So in F2, we can use those terms interchangeably. The first technique that we're going to be looking at then is payback. And that literally looks at how long it takes for the cash flows of the project to pay back the initial investment. So if you spend £100 on something that's going to save you £25 a year, it's going to take 4 years for it to pay back. And the company then will accept projects. So this is how we're going to use it as a technique if the payback period is less than the company's target. So they will have a target that all projects must pay back within X number of years, and they will accept the project if it achieves that. Shorter payback is preferred when choosing between projects because it's less risky. So Kirby here then is considering a project for 5 years, and it's going to involve spending $550,000 on equipment. And that equipment will have a scrap value of $25,000 at the end, and the operating revenues from this equipment will be $150,000 for 5 years. And the company has a cost of capital of 10%. Well, actually, to do our payback, we don't need a cost of capital. What we need then is to know what the target for payback is. And the target is 5 years. So if you get your money back within 5 years, then it's going to be a good idea. It's going to be acceptable. So the best way then to decide if something should be undertaken based on payback is to set up a little table and look at the cumulative cash flows. So initially then, we're going to spend $550,000 on this equipment, and the cumulative cash flow will be negative $550,000. In year 1 then, there will be an inflow of $150,000, so the cumulative position will be negative $400,000. Then another $150,000 in year 2, so that's going to give negative $250,000. Another $150,000 in year 3, so that will be negative $100,000. And another $150,000 in year 4, so by the end of the 4th year, we have a positive figure. So the payback period is going to occur somewhere between year 3 and year 4. If the cash flows arise evenly during the year, then it's going to be 3 years and then two-thirds of the way through the year, so that will be 8 months. 100 divided by 150 times by 12 is 3 years and 8 months. And the project is going to be acceptable because it pays back within 5 years, which was the target. We don't even need to start worrying about the $175,000 of inflow in year 5. What you may have noticed here then is that we had the same inflow each year, so we had an annuity. If you come across the payback with an annuity, you can, as a shortcut to using this table, use 550, so the amount, divided by 150, and that will give you 3 2/3 years, so the same answer. But that only applies if the benefits are the same every single year. So what are the advantages then of payback? Well, as we've seen, it's quite a quick and simple calculation. It's very easy for non-accountants to understand this idea of payback, of getting your money back. And it's linked to an important concept for success, which is liquidity, thinking about when the timings of the cash flow. The disadvantages of it, though, is that the length of the company's payback is an arbitrary decision. It also doesn't think about when the money comes in during the payback period, so whether it comes in immediately or whether you have to wait a bit longer. It also ignores cash flows after the payback period, and in ignoring the timing, doesn't think about that concept that we've just said, which was very important, which was the time value of money. Some of the disadvantages can be overcome by discounting the cash flows and preparing what we call a discounted payback period. It's calculated in the same way, but there's another step to discount the cash flows. Given the net present value then is all to do with Given all that we've said about the time value of money being important, net present value is an important investment appraisal technique because it discounts all of the cash flows and looks at the difference between the amount that we've invested and the discounted cash inflows expected, and it leaves us with a net difference, which is the net present value. So what we need to do then is to work out all of the expected inflows and outflows, discount them, and then add up the total of the inflows and take away the outflows. And we use that then to establish the maximum amount that an investor would be prepared to pay for a set of future cash flows. And that's based on the investor's cost of capital, and it takes into consideration the time value of money. Unlike payback then, it's taking into consideration the time value of money, but there's also a very clear decision rule. If the NPV is greater than 0, then the project is worthwhile at that discount rate. And the higher the NPV, the more worthwhile it is. So if you're choosing between two projects, you need to choose the one with the highest NPV. And these factors make it the superior or the best investment appraisal technique that we have. If it's negative, you know that you would want to reject the project even if all of the other methods are favourable. And that's because it's the superior technique. And that's an important fact to remember for multiple choice questions where you might be given the results of the NPV, the payback and other methods, but if the NPV is negative, you would always say not to go ahead with the project. In example 9 then, we're calculating the NPV of Kirby's project, which is what we looked at in example 8, and advising them whether to proceed. So we start off with a table, but you'll notice that we have got an extra table, an extra column, which has got the discount factors. And these discount factors you need to be able to pull off the tables in the exam. Remember, those are in Appendix B of your notes. So initially then, we were paying out 550,000 of cash flow, and that outflow in present value terms is worth 550, because a pound today it still is worth £1. There's no time value of money involved there. Each year then we've got inflows of 150,000, but in the final year we've got the inflow of the operating revenue of 150,000, and we've also got the 25,000 of scrap. So now we need to crunch the numbers to come up with the present value of each of the cash flows. So we're discounting the cash flows in the way that we were earlier in the chapter. 150 times by 0.909, 136.25, 150 times by 0.826, 123.9, and we carry on multiplying the columns together until we've got a total we need to add up all of the inflows, take off the outflows, and that will give us the net present value. So to keep the numbers simple, I worked in thousands. That's $34,025. And the NPV is positive, so therefore we want to accept the project. Because remember, our decision rule with NPV is if it's positive, accept. So the advantages then of NPV are that it accounts for the time value of money. So the cash flows that are earlier on, that are received earlier on, if we look at this example, have a higher present value than those that you have to wait longer for. So the first 150,000 is worth 136, but it goes down to 102. That's because you'd have to invest it for longer, get more interest. It's based on relevant cash flows, and we'll be looking more at those in a moment. And it's an absolute measure as well. So rather than a ranking, it tells us how much our shareholder wealth is going to go up by if we undertake the project. So it directly answers the question, what is the impact on shareholder wealth? The disadvantages are that you need a cost of capital, and fortunately it's beyond the scope of F2 to calculate that cost of capital. That comes later in your qualification. But it is a tricky concept, and it doesn't allow for all of the risk of the project. The final technique that we have here then is internal rate of return. And the internal rate of return is basically the break-even cost of capital. It's the discount rate that would give an NPV equal to 0. So the present value of the future cash flows would be exactly equal to the present value of the inflows. So it's the actual return that the project is generating. Now, to calculate the internal rate of return, we have to use this formula. And unfortunately, it's one that you're going to have to commit to memory, and there aren't really any easy ways to do that. So perhaps writing it down every day might help. B is the biggest discount rate, and A is the littlest one. So you start off with the lowest discount rate, and you add it to the NPV of the project at discount rate A, divided by the difference between the NPV of the projects at their two discount rates, times by the difference between those discount rates. But we'll have a look at it with some numbers in a moment. The decision rule then is that if the IRR is greater than the cost of capital, then the project is going to be acceptable because it would have a positive NPV at the cost of capital. It's successful as a technique because the idea of the percentage return is readily understood, especially by non-accountants. Also, it doesn't need an exact cost of capital. Although in F2 you'd be given a cost of capital, in reality it's quite hard to calculate sometimes. Problems with it are, though, that it's a relative return, and that can lead to the incorrect ranking of projects. So NPV remains the superior technique. So let's have a look at this formula then, which might not seem too pleasant on first glance. To calculate the IRR, we need to use this formula, and it requires us to work out the NPV at two different discount rates, A and B. So what we're going to have to do is to work out two different NPVs and then put them into the formula. So let's have a look then at this in lecture example 10. So in lecture example 10, we want to work out the IRR of Kirby's project. And this first column here is what we did in example 9. We worked out the NPV at 10%. If the NPV is positive, the second discount rate that you choose must be higher. Because what we're effectively trying to do with the IRR is to find the point at which the cost of capital is going to give an NPV equal to 0. So what we need to do now then is to appraise the project at a 15% cost of capital. So we need to get the 15% discount factors from the table and work out the NPV. So once you've done that, you'll see that the NPV at 15% is negative 34,625. With IRRs, it's always a good idea to think about your answer before you plug it into that formula. So the NPV is positive at 10% for 34,000 and it's negative 34,000 at 15%. So we have an expectation, hopefully, that the IRR will lie somewhere between the two and somewhere very close to the middle, about 12.5%. Let's pop it into the formula then. So the IRR is approximately equal to A, which is 10%, plus the NPV of the project at 10%, which is 34,025, divided by 34,025 minus, but a minus and a minus make a plus, 34,635, times by the difference between the discount rates. So 15 take away 10 is 5. Plug all of that into your calculator and you should come up with 12.5%. So you need to practice these IRR calculations, practice using the formula and make sure that you get the right answer, and then you can practice learning the formula. So in the exam then, we could be given the net present value at several costs of capital and have to calculate the IRR. So the NPV of Transco's project is positive at 10%. So that means that the IRR has got to be greater than 10%, but it's negative at 15%. So that means that it's got to be less than 15%. And we'd expect the answer to be it's closer to 15 than 10. So remember, we have an expectation beforehand, and that might help us to eliminate some of the incorrect answers. So the IRR then is equal to the lowest discount factor, which is 10, plus the NPV of the project at the biggest discount rate divided by the NPV at the biggest rate minus the NPV at 15%. A minus and a minus makes a plus, so that's 2,190 times by the difference between the discount rates. So multiply that by 5. In terms then of putting it into your calculator, we need to do the 4645 divided by open brackets 4645 plus 2190, close brackets first, multiply that by 5 plus 10, and that gives us an answer of 13.4%. And doing a sense check on this at the end, it's in line with our expectations. It's between 10 and 15%, and it's slightly closer to 15. Example 12 is a very similar idea. At a discount factor of 10%, the NPV is 250. When the interest rate goes up, so a discount factor of 11%, the NPV falls by 50 to 200. So what we need to do now then is to do an IRR calculation. And we expect then that our answer is going to be greater than 11. So the IRR then is equal to 10, smallest discount rate, plus the NPV at 10% divided by the NPV at 10% minus the NPV at 11%, and it is a minus here because that number is positive, times by the difference between the two discount rates. So 250 divided by 50 plus 10 gives us an IRR of exactly 15%. In example 13 then, we need to see which of the four statements is true. So the cost of capital, the discount rate is 12% and the IRR is 16%. The return on capital employed is 21 and the payback period is 3 years. We need to have a look then which one is true. Statement A, the project is worthwhile because the IRR is a positive value. Now, don't get drawn into this one because actually we would be looking at accepting projects with a positive NPV. So it's not going to be answer A. The project is worthwhile because the IRR is greater than the cost of capital. Well, actually, that one is true because the IRR is 16%. That is the cost of capital at which the NPV would be 0. We want to accept projects with a positive NPV and the NPV would be positive at 12%. So the project is worthwhile. The next two statements say that the project isn't, so the answer must be B. Let's see why C and D are incorrect then. Well, the IRR is less than the return on capital employed, but they're not comparable, so it doesn't matter. And the project is not worthwhile because the payback is less than 4 years. Well, with payback, we want it to be as short as possible, and we don't actually know what the company's criteria is here. NPV calculations and other investment appraisal calculations are always based on the relevant costs. So what we need to do now is to make sure that we're happy with what we mean by relevant costing. So a relevant cost then is something which is going to arise in the future as a consequence directly of the decision. So we're thinking here then about costs which we want to use for decision-making purposes. We classify it then as a future incremental cash flow. And we're going to look at each of these criteria in turn. It's got to be money then that's going to be spent in the future. We can't go back and change the past, so any cost that has already been incurred is said to be a sunk cost. Even if we haven't actually paid it, but we are subject to pay it through a legally binding contract, perhaps if we've pre-ordered some materials, that is a committed cost, and we're also going to exclude that. So for example, if I already hold some materials in inventory that I've already paid for and can't get a refund on them, what I paid for them in the past is irrelevant. The second criteria then is looking at incremental costs. So these then should go up as a result of the decision, and we want to think about increases. So for example, we may be incurring our fixed overheads anyway, so we'd only want to look at incremental fixed overheads if perhaps we had to rent some additional space. To be a relevant cash flow, the item has to have a cash impact. So we're going to exclude things like depreciation and exclude any fixed overheads which have been apportioned and all of our overheads which have been absorbed. So it needs to be a cost which is avoidable or differential or results in an opportunity cost for it to be relevant. The things that we never include as relevant, as I've said, are those sunk costs, committed costs, and notional costs. So the company is paying rent anyway, but you charge it to a project. We might need to include then calculations for a relevant cost of a material to be included in a project. So in lecture example 14, a company is undertaking a special contract and we need 300 litres of A and 200 litres of B. And we've got some inventory because both of these products are regularly used by the company for normal production. And we're told what we paid for it, which is the historic cost, and we're told what it costs today. So what we need to think about then is what's the relevant cost of A and B. So for B, material B, we need 200 litres and we've got 200 litres. We're not, however, going to include the historical cost, because that historical cost is a sunk cost and it's never relevant. So regardless of whether we already have it, the relevant cost is going to be what it would cost us to replace it. Because if it's in regular use, the assumption is that if we use it for this project, we're just going to have to replace it for our ordinary production. So for A, we need 300 litres and the replacement price is $4. And for B, we need 200 litres, and if we take what we've got in inventory, we're going to replace it. The relevant cost is $7.50. The relevant cost is $2,700. What we'd have to pay today to obtain those items. Lecture example 15 is an example of a section B style question. The techniques then are different to the section A questions. Having a look in the skills bank, you'll see that we have identified some of the things that you need to do in key skill 4. And I'd recommend that you have a look at that before we do this lecture example. So the biggest difference with the section A questions on first glance is the amount of information that we have here. So rather than reading through all of the information, let's actually start off by having a look at the requirements. So we have to state then whether the following items are relevant or irrelevant cash flows for a net present value calculation. So we need to decide whether they're relevant or irrelevant. We've got quite a few items there, and in the computer-based exam you would choose on the drop-down menu whether they were relevant or irrelevant. The reason for looking at the requirement first is now when I read through all of the information in the scenario, I can be looking at those items and writing or deciding whether they're relevant or irrelevant. We then in part B have to do some calculations to look at calculating incremental sales. Remember, incremental means additional, so we just want the extra sales in year 1. The savings that are going to occur in the cleaning costs in year 1, and the present value of the maintenance costs for the entire life of the contract. So with an NPV question, it's important to look at the timings as well as what it is we're actually being asked to do. So having read through the requirements, we can now have a look at all of the scenario information for Pizza Co, this pizza restaurant. So last year then we had sales of $500,000, and we know that that's going to be important because in part B1 we need to look at incremental sales. And it's considering replacing the ovens with some new modern ones, and the aim being to grow customer numbers. And we're given some information then about the costs involved, and we'll need to read through that information to decide if they are relevant. So the first point then relates to the cost of the new ovens of $350,000, and that's the first thing in A1 that we have to say whether or not it's relevant. Because the ovens haven't been bought, it says would cost, so we assume then that if we want these ovens, we're going to have to go out and buy them. So that is a relevant cost. The next item on the list is depreciation, which is the next requirement. So will the depreciation be included? Well, hopefully the minute you see the word depreciation, you know that it's not relevant because it is not a cash flow, it's an accounting estimate. To Staff training then, we've got two things here with staff training, and in point 5 of the requirement we have to consider the staff training costs of 7,000 and the staff training costs of 10,000 in point 3. So 7,000 has already been spent, and it's this already been spent on staff training to evaluate. Well, because it's already been spent, it's not relevant because it's a sunk cost. Further costs for training of 10,000 would be, so it's in the future, be required if the new system is implemented. So that is a future incremental cash flow, so that's going to be relevant. Sales then are expected to rise. Well, we're going to need that for part B. So we'll come back to that in a moment because that's not in the list of relevant costs. Cleaning costs as well, that's going to be in part B. 3 new members of staff, their salaries then are in part 4 of part A. These members of staff then will be recruited to deal with the additional demand, and they're going to be paid 45,000 per annum. We wouldn't recruit them if we didn't have the extra demand, so therefore that will be a relevant cost. Maintenance costs, we're going to need that as well for part B. Interest costs of 10,000 per annum. Now this is quite an interesting one with the interest costs because the criteria for deciding if a cost is relevant is a future incremental cash flow. And on first glance, interest is a future incremental cash flow. However, it's the one exception to the rule. We never include interest because interest is included in that cost of capital. So the compensation for interest is part of the cost of capital. So interest is not relevant, and it never is. So you need to make sure that you learn that fact. So in reading through the scenario then, we've got answers to all of part A. And if you'd read through that before you knew what the requirement was, it wouldn't have been as an efficient use of time. So just to recap then, the purchase of the ovens is relevant. Depreciation is never relevant. Staff training costs of 10,000 are relevant because they're in the future. But the costs of 7,000 that have already been paid are not relevant. Salaries for staff are relevant, and interest is one of those oddies, but interest is never relevant. Now in part B, we can do the calculations for the incremental sales. So what extra sales are we going to get as a result of having these ovens? Well, we need to refer back to this note up here, to note 4. Sales are expected to rise by 600,000 in year 1 if the ovens are purchased, thereafter increasing by 10%. If the ovens are not purchased, sales are expected to rise by 10,000 per annum. So we would have been expecting an increase of 10,000, so we've got an extra 590,000 of sales as a result of these new ovens. In part B then, we need to do some calculations, and we're going to begin by looking at the incremental, so the extra sales in year 1. The information then for this we identified was in note 4. So sales then are expected to rise to 600,000 in year 1 if the new ovens are purchased. So at the moment then sales are 500,000, so the new ovens are going to see a rise in sales of 100,000. However, if the new ovens weren't purchased, sales would have gone up anyway by $10,000 per annum. So the extra sales that are due to the purchase of the new oven, due to the project, are $90,000. So with the incremental, we're looking at the extra sales, which in this case are $90,000. Part 2 then asks us for the savings in cleaning costs. The saving costs are expected to fall as a result of the new ovens, and these are estimated to be 1% of total sales. So the savings then are 1% of total sales. So we're looking at 1% of the total sales of $600,000. So we're looking at savings of $6,000. Finally, in part 3, we need to work out a present value. So we need to do a bit of discounting here. And we're looking at maintenance. The new ovens then are going to require maintenance, and that's going to have a cost of $2,000 for each of the 5 years. Because it is the same amount each year, it's an annuity. So the present value of an annuity is equal to the annuity times by the cumulative discount factor. We're looking at the present cost for 5 years, so we want the cumulative discount factor for years 1 to 5, and the firm's cost of capital is 10%, so it's the 10% factor. The cumulative discount factor for years 1 to 5 at 10% is 3.791 from the tables, so the present value of the savings is $7,582. Chapter 11 was quite a technical chapter on project appraisal, and you need to make sure that you're happy with the basics before you progress through too many questions. So cost of capital then is the compensation that we're giving investors for the fact that they're parting with their money now rather than investing it. So it's all about compensation for the time value of money, recognising then that $1 today is worth more than $1 in the future because of this interest that you could get from investing it, inflation, change in purchasing power, and risk. Investing in a project is more risky than putting your money into the bank. Compounding then is looking at getting interest on your interest basically, and we also had a look at non-annual rates of interest and said that we need to convert any nominal rates to equivalent annual rates or APR. Discounting then is the opposite of compounding. It's when we take the terminal value, the end value, and discount it back to today's terms. And we can do that using either the tables or the formula if the values fall outside of the table. Remember though, with the discounting, the first set of tables is when we just have a one-off cash flow. We use the cumulative discount factor tables when we have an annuity, the same amount for X number of years. And to work out the present value of an annuity, you have to use that second table, the cumulative discount table, where the sum of the discount factors has already been added up for you. We can work out for loan repayments the value of each repayment, taking into consideration the capital repayments and the interest to give one annuity. A special type of annuity is a perpetuity because it's paid forever. So the present value of an annuity is equal to the annuity times by the cumulative discount factor. The present value of a perpetuity is equal to that perpetuity times by 1/R. We then looked at some investment appraisal techniques. We looked at payback period, how long until the initial investment is recouped. And we also looked at net present value. Net present value is looking at all of the discounted cash flows of the project taken away from the investment. And hopefully, if that NPV is positive, then we will accept the project because it's a good idea, it's going to increase the wealth of shareholders. So NPV then is the superior investment appraisal technique, and the decision based on NPV ranks above the others. IRR, or internal rate of return, is also a useful technique because it's the discount rate that gives an NPV of 0, so the break-even cost of capital. And you need to remember the formula for calculating an approximation of the IRR. When we're using NPVs, we need to include relevant costs. The characteristics of a relevant cost are that it's a future incremental cash flow. And you need to make sure then that you practice questions to make sure that you understand using these techniques and using the discounting and compounding.